Going live. All right. Beautiful. Perfect. I think we're live.
I believe so. Hello, folks.
Hello and welcome. And we've got exciting things to talk about today, so I want to make sure we get started right away. And that's going to be our topic today. 5 things that you absolutely must consider before using your business credit for personal expenses. You know, this is a topic that people don't necessarily
must consider.
Before you need.
Well, here we'll run down them real quick. What we're going to be talking about today.
For personal expenses.
There we go.
Hey, folks, welcome back. Here, I'm going to run over them real quick. So the 5 things that we're going to be covering today is do not commingle your business and personal funds. We're also going to be going over understanding the power of write-offs, understanding the difference between informal and formal lending, as well as being aware of credit lines, limits, and really what you can afford. Moving on, the very last thing that we're going to touch base on is understanding the impact of leveraged credit on your credit score.
Perfect. So, I mean, most people will tell you that you need to avoid using business credit cards for personal expenses, right? But I mean, week in and week out, we talk about the advantages of using business credit. We talk about credit banking and the synergy between the two. And we talk about so many different things that it gets people kind of confusing. We get a lot of questions about, well, wait a minute. How are you supposed to do this? Because you're not supposed to do that. And so today we want to talk about, because so many of the strategies that we talk about, whether it's credit banking or whether it's business credit, hinges on these 5 things that we're going to cover today that really help you understand how that you can actually merge these 2 things that are really supposed to be kept separated.
Right.
But how to do it the right way.
Exactly.
So let's talk about the first one, because it seems like the first one is do not commingle business and personal funds. But wait a minute. It seems like we just said you could, but
If done the right way, though.
But now we're saying don't.
Well, it's pretty hard to always keep everything from being commingled to some degree. But I guess that's the word of commingling is mixing together. And as far as, I think the biggest problem is when you don't know which is which in the accounting aspect.
Right. So my attorney tells me, and I have to say my attorney because I'm not an attorney. Mm-hmm. You're not an attorney. I'm not a CPA. You're not a CPA. So we consult with professionals. And the way my attorney puts it is that when you transfer funds between your business account and your personal accounts without what's called the appropriate documentation, there are so many ways that can actually end up hurting you. Mm-hmm. Because your creditors could come after you and they could legitimately pierce your corporate veil. And then on the other side, the IRS could audit you, and then whatever money your business lent to your personal side, they could deem that as a dividend or income, and they could tax you on it.
Absolutely.
So you don't want to commingle business and personal funds. That is the thing that everybody's trying to avoid. So so when we said what is the appropriate documentation, a lot of people just, you know what, they don't even want to think about it. Oh, there's hoops to jump through. There's ways to twist yourself in a pretzel. So you know what, we're just going to tell everybody a blanket, no, don't do it. Whereas if you get educated and you understand these things, you can actually leverage this to your advantage.
That's very true. Yes.
So we want to make it very clear that getting educated is really the key to understanding a lot of this, because you do need to understand that it is important not to commingle business and personal funds, but because the power of the business is in its liability protection And the power of a business is also its ability to generate additional streams of income that you could then leverage and use not only for your business, but for your personal side. But too many people are, I can't think of a better word, lazy. They look for shortcuts, and that's what hurts them in the end. They're either lazy because they didn't learn, they didn't think about it, or they took shortcuts because they're like, I don't want to do all that paperwork. And so
I know for me, I just don't like doing paperwork, period. So but I mean, I've asked a couple different CPAs, and then some will say you can, some will say you can't, some say it depends. And so our hope is that we can kind of shine a little light on that today. And
right. So technically, all three of those answers are correct.
Right.
No, you can't commingle funds. Right. Yes, you can find ways to use your business for personal expenses, which we're going to talk about right next. And then it depends is also a great answer, because depending on how you choose to use those funds and the way in which you disperse them, it depends. That's what depends on whether or not it's a yes or a no. Right?
Yes.
So let's talk about one of the most powerful things that you need to understand, and one of the easiest ways to start using business credit for personal use. And it really is understanding the power of write-offs.
Ooh, yes.
A lot of people, they learn about business and they learn about all these tax saving benefits that you can have by starting a bit. If you're a business owner, a real estate investor, right? There's access to over 400 different write-offs just in the IRS tax code alone.
Ooh, that's a good amount.
I mean, if you think about it, like I've heard it said that if a tax code was written out on 10-point font on single sheets of paper, single spaced, that it would be a stack of paper 6 feet tall.
I believe that for sure.
And like a 3-inch portion of that would be for personal taxes.
And the rest is business.
The rest is for business. So, I mean, once you understand the power of write-offs, I mean, what does that mean? The more you write off, the more you lower what's called your adjusted gross income. And the lower you get that adjusted gross income, the more tax you save, right? You don't have to pay that because you're reporting a lower amount and your taxes are based off of a percentage of the income reported, right? So that's pretty clear. So here's the problem. And we did a video on this just yesterday, right? It was released on AGI and taxes. So what people do is they live their lives and they get taxed just normally, right? Your income tax, everybody gets taxed, your consumption taxes, your sales taxes. And then at the end of the year, you pay your taxes, right? If you've overpaid, then you get a refund. If you haven't, then you've got to pay taxes. Then after all that, then we go and pay for all of our expenses. And when we pay for our expenses, after we got our income that was taxed, we bought consumables that are taxed.
Right.
We paid our federal taxes, our property taxes.
Right.
And then after that, we buy more stuff. The car, the cell phone, the house, all these things that go with it. And we're taxed on all of those. And you pointed out yesterday, you're getting taxed 3 different ways.
Right. Taxed, and then taxed again.
And so what we're doing, when you understand the power of write-offs, is when you can take aspects of your personal life and convert them over to the business. And when you convert it over to the business, it becomes a write-off. So instead of it being something that you then pay as an expense and then get taxed on again, it all becomes a deduction that lowers your adjusted gross income and helps you save tax. And when you save tax, the bottom line is you keep more of what you make. And that's what everybody wants. Because if you start adding up all the taxes you pay and all the fees and regulatory items that you pay, permits and everything, licenses, registration, everything, half of your entire income goes out. You don't even, whatever you're making, you're living off of half of that.
Mm-hmm.
But when you learn the power of write-offs, you get to keep more of what you make.
Makes a big difference.
I mean, there's no way to get away from paying taxes. Everybody pays taxes. But there's a way as a business owner that you're incentivized by paying lower taxes, because what are you doing? You're providing goods and services that people want and need. And this is creating jobs and stimulating the economy. So the government wants to incentivize that. So they do that through tax write-offs. So here's the thing: when you take your car and you use it for business purposes, then you can actually have your business by your car, right?
Ooh,
Your
yeah.
cell phone. You start using your cell phone for business purposes instead of being a personal cell phone. You can then make it your business cell phone.
I like that idea.
Right? Now, here's what's great. Because you're still using them for personal uses, and you've got to make sure you follow the IRS tax code, because there's a percentage that you use for mileage. For if you have a house in your mortgage, you can deduct a certain percentage of the mortgage for home office use, right?
Right.
But at that point, now you can start using your business credit cards to start paying for things that you use personally. But if you cut corners, right? Well, yeah, I'm going to do it that way, but no, you actually have to take your business and actually have it buy your vehicle. You have to get your vehicle put in your business's name. Oh, well, that's going to take time. I got to go to the DMV. I got to create a bill of sale. You got to do all these things, right? But do the little paperwork that's necessary, and then get the huge write-off that goes with it.
Well, if you think about it, it's if you don't want to do it, you're going to end up paying somebody to do it, and you can either pay the government just for not wanting to do it, or you could actually build your business around it.
Absolutely. I agree with that. You're going to pay for it. Actually, when you say you pay for it one way or another, I think it's very inexpensive, the time and the paperwork that it takes to put your vehicle in your business's name versus the time and money that it takes for you to give money interest-free to the government that they hold on to a year before they give it back to you.
And that's the other thing too. Yeah, it's so many pros and cons to that situation.
But here's what's important. You must understand that we're not CPAs, we're not accountants, and you really do need to listen to what we're saying here, but also consult with competent legal professionals that understand how these write-offs work in your state, because sometimes the laws change based off of which state you're in, and make sure that these principles apply to you. But once you understand the power of write-offs, and you can convert your average ordinary everyday expenses into business expenses, now it becomes okay to use your business credit to pay for things that you use on the personal side.
Really minimizing that at the end of everything, at the end of the year, how much you actually are going to get taxed on. Reducing that is a beautiful, beautiful thing.
Well, let's move on to the next one. Understanding the difference between informal and formal lending. Do you know the difference between the two?
Well, a little bit. It depends on if you are borrowing it from. Are you talking about like if we're borrowing it from like an institution, or we're borrowing it from ourselves?
I'm saying you're Ray Fleming, and you own a business. Let's call it Rayco, right? And so your right hand is Ray Fleming, and your left hand is Rayco. You pull money out of your right hand pocket, and you give it to your left hand. You put it in your left hand pocket. That's called informal lending.
Yes, actually, my accountant has slapped me on the hand several times and sat me down. No, we can't do this. So, because then he's asking, hey Ray, 7 months ago when you pulled out cash from here and you deposited portion of that into the business account, what was that for?
Where's the documentation?
That's a great question. I have no idea. And
so it's really easy. It's really easy to do informal lending, right? We do it all the time. You move money between accounts, instant transfer back and forth, the money in the savings, and pull it up over here, and then let's move that over to the business account. I need to pull money back over.
So really, a paper trail versus no paper trail.
Right. So that's called informal lending, and that's a big no-no because there is no paper trail. It's considered commingling. So that means if you let's say you can't pay a debt and you go into collections, well, the company that you're in debt to can pierce your corporate veil. That means you have no liability protection, and then they can go after your personal assets. Right. So now you've erased the whole, just by informally transferring money back and forth, you've erased the corporate veil protection. And then the second thing is if you go through an IRS tax audit, they'll look at all this money that's going back and forth. And since you have no documentation on it, they'll say, well, as far as we're concerned, that's income.
Yeah.
And then you're looking at that, well, that wasn't income, and then you'll get taxed twice on the money that you already have.
Ouch.
So to avoid that, so
What is that thing they say? He with the most documentation wins.
Okay, so listen, here's what's needed, right? You have to, when you put yourself out there, if you are really going to take money from your business and lend it to your personal side, there's a process. What is the documentation that we're looking for? We're talking about getting a promissory note. A promissory note has several things in it. It has an interest rate for the money that's being lent. It has built-in regular payments that must be made on the principal and the interest, right? As well as collateral. Now, that depends on the amount. If we're talking about small amounts, right, and that's going to also vary based off of how much you process. But let's say we're talking $500 or less. If your average processing is, $5,000 or less, then that's a small amount of money. And you can make small little loans, and those can be unsecured. But let's say you're going to move 5,000, 10,000, 20,000. Well, now there should be appropriate collateral, whatever. And again, when we say appropriate collateral, every state has certain laws that determine what is appropriate, which is why it's good to have a CPA or an accountant that you consult with at least to make sure. But if we're talking about small amounts, and I mean, if your business is regularly doing, let's say, $50,000, $100,000, and you got all this cash flow that's coming in annually, a $5,000 loan is not that big of a deal. That could probably be unsecured.
Right.
But if your whole cash flow for the year is $5,000, then comparatively, that's pretty big to the amount of money that's coming into the business. Does that make sense?
Mm-hmm. Absolutely.
So, I mean, you could still possibly make it unsecured. Again, you need to talk with your professionals, but not only do you need to create a promissory note with an interest, and it's got to be enforceable. It can't be, so a lot of times promissory notes are either notarized to verify the individuals that are participating in that, but they're witnessed. When you have collateral, let's say you're using your house, you're putting a lien, and that's filed at the county. And people are like, well, that's extra work, to do that. But I mean, if your business is going to lend you, say $100,000, $200,000, you should, put together this promissory note, this private, mortgage note, and then also get a lien against the property to protect the business.
It's not a bad idea.
Again, you're still just lending to yourself. You're paying yourself back with interest. So, I mean, there's no problem there. And then your regular payments could be monthly. You could set it up as bi-monthly, quarterly. You could defer payments for the first 6 to 12 months. And you could have a balloon payment on the end. There's so many different terms and rates. As long as it conforms to whatever state law allows, then you're good to go. But you've got to have this note, and it has to be recorded in your accounting. So in your accounting, whether you use QuickBooks or you use whatever, I mean, if you use just your own ledger, you've got to have a line item that when money comes in, it's not getting counted as income. It's being recorded as a loan money coming in, right? So there's got to be something in your accounting, or what's called your books, that accounts for the loan appropriately. So if you can do that, then what you're doing is formal lending. And guess what? If you default on this loan or something goes wrong, there is enough documentation that keeps your business and personal separated so that creditors can't pierce the corporate veil. And if the IRS were to audit you, they would not be, because of the appropriate documentation, right? They're not going to say, well, that's income to you personally, you have to pay taxes on it, right? Because you have the documentation in place. Wow.
That's a yeah.
Who would have thought we would have got so meaty today on some of this stuff? But, here's something I think really good. The next one to talk about, this is one that's near and dear to your heart. Being aware of your credit line limits and what you can afford. Because business credit allows you to get 10 to 100 times more than what you get on the personal side. But you've worked with a lot of clients. What happens when they get that, $15,000 gas card?
Well, there's some of them go a little bit crazy and spend a lot. It's like kind of like a shopping spree. Like, all right, let's just not do mine, but my neighbors. And your business credit score, it's one of those things that you can get out of hand with it. It can, if you're not careful of it. But the other thing you got to think about, your business credit score is only affected by one-time payments. And so
On-time payments?
yes, that's what I meant. On-time payments.
Right.
So, for example, if you're getting a gas card in the beginning, and a lot of the gas cards tend to be net 30 accounts where they are due, within 30 days. And so if you do not pay that full balance in 30 days, then that can be a serious bad mark on your credit. I mean, they'll stay on there for 3 years, and it's pretty hard to achieve an excellent business credit rating when you have late payments.
Well, another thing that I've noticed is that we get a lot of folks that once they do build their business credit, and they do get a lot. I mean, working with us within like a span of a year, they might have $150,000 in lines of credit, and then they look, well, why don't I move, all this personal debt into the business? But now they can't afford to make some of the payments. And then what you were talking about is they end up hurting the business. There's some people that have a crazy idea, and I don't want to give you any crazy ideas because this is a bad idea, but they think that they can put all their personal debt into their business and then just let the business fail, like the sink, right?
That's easy for any type of bankruptcy court or anything like that to really go through, and they're going to pull that apart. And so if you have that idea that you can just build business credit, pull your debt over and walk away, it's not going to work that easily.
So we're talking about how to use business credit for personal expenses. And so you just have to be smart about how much you move over and that you can afford to pay it, make all your payments on time. Because you miss one payment, there's no grace period with these business credit cards.
No, not at all.
1 day late and you hurt your credit. And if you end up hurting your credit on the business side and can't afford to get credit anymore, then that can begin to unravel your whole plan of using business credit to help you on the personal side, right? And so we don't want to see that happen to you folks. So last but not least, let's talk about number 5, which is understand the impact of leveraged credit on your credit score. All right, so we've already established that there are ways to use business credit for personal expenses, right? Especially when you understand tax write-offs. You can now take different line items in your expenses and turn them into legitimate business expenses. With legitimate business expenses, you can then pay them off with your personal, with your business credit cards. And we've talked about how to give a loan from your business, from the business to your personal side with the appropriate documentation, and that can really help on your personal side, especially if you've shipwrecked your own personal credit, right?
Yeah.
And now you have no access to any credit. Now this can start to pay down some of your debts. And when we can lower your debt to income ratio, lower your credit utilization, we can begin to repair your credit score.
Absolutely.
And make you credit worthy. So what I think that people don't recognize a lot is that the differences between the personal credit cards and the business credit cards. So take for example, if you have a $20,000 credit card on your personal side, this utilization, which is huge on your calculating your FICO score, how much of that $20,000 can you use without damaging your credit on the personal side?
Well, so if you have are you talking about okay, so if you exceed, say, $6,000, that would be about, that's when you're going to start to see that
that's 30%.
Yeah, it's 30% that's starting to have some negative effect to your score. Really going over that 50% barrier is when we're really going to start to see the decline in your personal credit score.
Right. So you begin to your credit, you're growing your credit as long as it's below 30%, and then it slows down as it goes above 30%. till it comes to a dead stop at 50. And then once you get to 51 and more, it now starts going down.
Yeah, and utilization, I mean, that's 30% of your profile. So that's a big impact to your personal credit score.
Right. So when we work with people, a lot of times they want to try to give a personal guarantee to their business. And one of the number one things we have to do is help them get under 30% utilization.
Yes,
on the
of
credit.
course.
Because I mean, if you're looking to actually get maybe personally guarantee up to $150,000 for your business, it can be done. You would just need to have a 680 credit score or better with your utilization under 30% and be able to show that you have verifiable income, monthly income that's coming in. And based off of that, you could get anywhere from 25,000 up to 150,000. It really just depends on what your largest line of credit is, and then multiply that by 5 or 8, and then that's really where you're going to be. So if you're
Gives you like a good ballpark.
right, if your largest credit card or line of credit is $10,000, then you know that you're going to get somewhere between 50 to 80, right? So I mean that's kind of how we look at it. But there is synergy between eliminating your debt with credit using a credit banking strategy where you push all your income through your lines of credit, right? And then put your expenses back on the line of credit. But you used the line of credit to take a big chunk out of your debt, right? So people on the personal side, they see credit banking as a strategy and they want to do it. And they'd like to get a home equity line of credit, or they'd like to get a personal line of credit, or a large high limit credit card to be able to do that. But a lot of times when they come to talk with us, they've already kind of made a shipwreck of their credit, right? And so business credit ends up being the vehicle that we use to help these folks gain access to lines of credit that they can then utilize these credit banking strategies to eliminate their personal debt very quickly. But we're eliminating that personal debt by all the ways we talked about here: creating a business and creating legitimate business expenses, moving personal expenses into the business, giving loans and lines of credit that are collateralized. Maybe you own a house, but you can't qualify because of your credit or your income to debt ratio for your house. And so, we're going to talk about that tonight, right?
Oh, yeah, I'm excited about that. Tonight is a really good night because that's when it really is that. How do we start to elevate it to that next level? The BHELOC strategy of, creating
we have a lot of people
creating your own economy,
right?
Really.
People are putting in a lot of requests. Show us how to do that. Show us how to do that. There is no one way to do it. There's so many different ways to do that, but it's like you said, or we say a lot, thinking outside the bank or thinking outside the box. Or if credit banking is a good strategy and business credit is a good strategy and infinity banking is a good strategy and insurance, using overfunded life insurance is a good strategy. What happens when you combine all these strategies together? Does that not create synergy between all that? So folks, if you're really trying to understand business credit and how to use it, when it comes to this last one, the impact of leverage credit on your personal credit score, with your business credit, it doesn't matter if you don't have to. What am I at 30% utilization? What about 50%?
As long as they're true business credit lines.
Exactly.
Because there are those credit lines that impact both your personal and your business credit profiles.
But here's what I think that happens with a lot of folks. They choose the quick and easy path. They just wing it. They figure it out as they go. They're going to learn it as they go. And the mistakes are, when you mess up your personal credit, it can take years to bounce that back. If you damage your business credit, that's a minimum of 3 years of not being able to access credit through the business anymore. But if they choose to work with the professionals, if you choose to consult with us, right? I mean, let's talk about where do you go to consult with us? I want to share something on let's see if I can share my screen here real quick. When you go to the Wise Guys and Ties, let me see here. I can do this.
Got a question.
Got to share my screen. Right, here we go. Share. Boom. Here's our website. This is where you go. And if you wanted to schedule a 30-minute consultation with us, it's really easy. Click on schedule with us. And then look what happens. You get access to our calendar. And there it is. And then you would click, select which day works for you, find a time that fits in your schedule. Now, if you're interested in more of the information we went over today and you'd like to go over it again, this is an article that I wrote on our website. And we have lots of articles. Just look right here. If you go to articles, 5 things to consider when using business credit cards for personal use. You can go through and read through the article that I wrote, which is a lot of what we talked about today. And there's a lot of other great articles here as well. And so what we want you to do is take advantage of what's on our website here and the plethora of information. But we also want you to take action. And so we know that for a lot of you, starting a business is the key to is the key to financial freedom, right? It's the key to building and growing and achieving your financial goal. It's the #1 debt reduction strategy. It's the #1 tax saving strategy. It's the #1 income strategy. Start a business. And if you're going to start a business, let us help you. Consult with us, and so we can help you right from the beginning, make it fundable, lendable. We'll help you build, start, and grow this business together. But you can only do that by going to our website, wiseguysandties.com and /schedule, or you can give us a call at 888-524-9273, and you'll be able to schedule an appointment with either me or Ray Fleming. We can't wait to work with you. We're super excited. Do we have any questions before we go? Or
possibly. I think I saw something in the chat there.
let's see. I think we had one question come in, and it was, I have business credit under a DBA. Should I convert it to an LLC? And how will that affect my current credit accounts? Well, your DBA is not really a business. Doing business as is what it is. It's a sole proprietorship. So you are the business. That means that any business credit account that you have is personally guaranteed because you are the business. So yes, you say, should I convert it to an LLC? The question is, yes, you should. You should convert your DBA to an LLC, but will that also move the credit? Well, yeah, you'll still be able to use the credit, but they'll still be personally guaranteed. So I recommend building your business credit through vendor accounts, revolving accounts, high limit cash accounts. And once you build your business credit, you should be able to go back to that credit account that you currently have and get the personal guarantee that you have attached to it removed. Great question. And that's really all the time we have for today. So folks, on behalf of myself and my business partner, Ray Fleming.
Good night, everybody.
We'll see you on the other side. Good night. And God bless.